The jobs report came out this morning. The economy added almost double the jobs anyone expected, nearly 172,000, against expectations of roughly 80,000. That's objectively good news. More people working, more income, more spending, a healthier economy. And then the stock market absolutely collapsed. If that makes zero sense to you, good. That's the right reaction. Because it genuinely isn't intuitive. And that's exactly what I want to walk you through today. Here's what most people miss. The stock market isn't the most powerful financial market in the world. The bond market is. It's bigger, it's older, and honestly, it's where the real signals live. Stocks get all the attention because they're exciting. Numbers go up, numbers go down, people tweet about it. But bond yields? Those quietly set the price of money for everything. Your mortgage, corporate loans, even how much investors are willing to pay for future earnings. When bond yields rise, borrowing gets more expensive everywhere. And that's exactly what happened this morning. For most of this year, markets have been quietly watching for one thing: signs that the economy is cooling down. Not collapsing, just slowing enough that inflation keeps easing. Because if that happens, the Fed has room to cut interest rates. And rate cuts are good for stocks, good for bonds, good for basically everything. So investors came into today's jobs report hoping for fine numbers. Decent, nothing too hot. Instead, they got 172,000 jobs. More than double expectations. That threw a wrench in the whole story. Here's the chain reaction that happened in about 30 minutes this morning. Strong jobs report comes out. Investors think the Fed now has less reason to cut rates. They start pricing in rates staying higher for longer. Existing bonds become less attractive. Bond prices fall, yields rise. That last step is the one most people don't get. Bond prices and yields move in opposite directions. Always. When nobody wants your old bond that pays 4%, because new bonds might soon pay 4.5% or 5%, the price drops and the effective yield goes up. The bond market wasn't saying the economy is bad. It was saying the economy is strong enough that the Fed doesn't need to rush. And when the Fed doesn't rush, that means higher rates for longer, which means lower stock valuations today. You might be thinking, I don't buy treasury bonds. Why do I care? You care because yields set the floor for almost everything else. Mortgage rates track the 10-year treasury yield closely. When that goes up, your home buying cost goes up. Corporate borrowing costs, same thing. And when companies pay more to borrow, that hits their profits, which hits their stock price. Even pure stock valuations get hit. When the risk-free rate goes up, investors need stocks to earn more just to be worth owning. So they're willing to pay less for the same earnings. That's why you saw a broad market sell-off, not just bonds. Here's the real takeaway from today. The market didn't tank because a strong jobs report is bad news. It tanked because strong jobs data pushed back expectations for rate cuts. And those expectations were already pretty thin. The chain is simple once you see it. Strong jobs. Fewer rate cuts expected. Higher future rates. Higher yields. Stocks reprice lower. That's it. That's the whole logic. And once you understand how the bond market shapes everything else, stocks, mortgages, corporate debt, you'll start reading market moves very differently. One good day of data doesn't change everything, but the market doesn't wait for certainty. It trades on probability. And today, the probability of near-term cuts just got smaller. If this was helpful, genuinely curious, did you know the bond market worked this way before watching this? Drop it in the comments. I read them.